Hi guys. So a lot of people have been asking about the concept of audit risk. Somehow they are not clear with this concept, and also why sampling risk is not part of audit risk. So this point has been asked by so many people, and with several MCQs that we have been putting up, this has been the issue. So you know, I thought why not let's do a session on the breakup of audit risk. A lot of times people don't have their conceptual clarity right. So in here the session today is completely going to be focused on how it is going to be phased up, to basically have an ideology of what we will be dealing in this concept of audit risk. So on that note, good evening to all of you. Let's deal with this concept of audit risk, and then I will also pick up the concept of sampling risk, explain both these, and then I will also take some of your doubts with respect to the concept. Let's deal with all of this and try and go ahead. Okay, so considering that, okay, so many questions already. Hello, sir, waiting eagerly for usually. Hi, guys, I did that. So, okay, good evening to all of you. Sir, please do upload videos in English, sir. English only is something that I'm doing, so don't worry about it. Uh, okay, all you intelligent people out there, let's do this. A lot of people, uh, yeah, hopefully, I should be finishing it off anytime around 1 hour. So let's go ahead, guys. So the concept is audit risk, and then even any of you guys watching it from CA final, I don't think there'll be any problem for you guys as well watch it. So let's go ahead with the concept of audit risk. Let me take a minute to sink in. There are people coming in. So the concept of audit risk. What is the concept of audit risk? What is the concept of sampling risk? And why sampling risk is not really the part of audit risk? What exactly are the components of audit risk? And let's go ahead seeing all of this. So all that I want to understand is how we will be facing this out and what can we do to understand this concept better. So on that note, let me go ahead first of all in discussing what are the major things in audit risk. So guys, just in case you have any doubts and all that, hold up till the time I see more people coming in. So yeah, as you guys can join, like you can put this up, but audit risk as a topic, it's a very important one. See the components of audit risk, if you're talking about broken down into risk of material misstatement, risk of material misstatement, and of course what I would also call as detection risk this side. Now first we need to understand where do these risks come from. What are the real reasons and where do these risks come from. If you look at that as to where the risk come from, risk of misstatement arises purely from the level of management, wherein detection risk, this one purely comes in because of the auditor's substantive procedures. So these are the points that one needs to consider in this concept of audit risk. First of all, if you're talking about what exactly audit risk, because see, I have seen a lot of people when we put up some MCQs about audit risk, they did talk about their answers with respect to which one is what risk is wrong, then what relations do they share, those are wrong. So, and what are the concepts that have been broken down into risk of misstatement, those were wrong. So considering all of that, let me go on a phase wise manner, wherein first we talk about what is the risk of misstatement, and then what is the detection risk. We do this and then we go one by one. Now talk about risk of material misstatement. Since this arises at the level of management, why does the risk arise in the first place? See, many risks arise in the first place only because of a simple reason that uh, controls are not there. So considering the risk that arises because of no controls, that is when you consider without controls, that is there are certain risks that the business inherently has. So I'm calling them as IR, which is, in other words, for the first time, since it is, we'll write it here, It is called inherent risk, the IR. Okay. Then moving further on that note, if you talk about, so now we are saying that this risk is arising because there are no controls. Then what are the next step that we'll do is to set up controls. Now when you do set up controls as an aspect, the fact of the matter is once you set up controls, now the inherent risk to an extent comes down drastically. But then what newly adds up is the other risk that is called as control risk. So this one adds up now. This is called control risk. So this one basically is the second sort of risk, and these two things, inherent risk and control risk, they make up the risk or misstatement. See, first of all, let me go off to the context of what is a misstatement. When you say misstatement is something wherein there is a susceptibility or a chance, or a misstatement where there is, a deviation where what is required versus what is reported, the chance of these two not being the same, what is supposed to be required by law or regulation, right? Required by law, statute, regulation, whatever you call it, versus what has been reported in the financial statement. The possibility of these not being same, if they are not same, then that is exactly when it is called a misstatement. Otherwise it's called as properly stated. Now basically what the point that we need to understand is, where are these risks arising from? Risk arises from the level of management at this point of time. So first of all, when you are running a business, there are several risks that you encounter, and in terms of financial reporting frameworks, there are certain requirements. But the fact is that when you do those activities which are not supported by any class of controls, so before even you start considering any controls, there are certain risks that exist. They're there in business for a simple reason that controls are not set up. By nature they are there. They're called as inherent risks which are there. Now when you look for what exactly is a control risk, now in the inherent risk, the story was what? That controls are non-existent, and that is why the risk is prevalent in the business inherently. Now you can't obviously eliminate inherent risk and bring it down to zero. That's an important point. I want you guys to note that and keep in your mind that we can't obviously bring this risk to a zero. As such, in all the total concept of audit risk also, it can never become zero. Audit risk can only be brought down to acceptably low level, right? Audit risk as such here I'm talking about can only be brought down to acceptably low level. That's all. You cannot do anything else with that. You cannot make it zero. It is only brought it down to acceptably low level. Now, considering that fact, if these two risks are the risks that are arising from management, then what is this risk that from the auditor's point that arises? So if you are looking at what exactly is arising from the auditor, this is called detection risk. These are nothing but risk that auditor's substantive procedure. Now auditor is performing substantive procedure, right? Risk that auditor's substantive procedures may not identify a misstatement. I still didn't define what audit risk is. I'm keeping it on hold, of course, because if you understand these three risks, you can understand the impact, and then I'll put up the audit risk definition. Okay, so inherent risk, control risk, and risk that the auditor's substantive procedures may not identify a misstatement, and that's exactly what we're talking about as auditor's detection risk. Now let me go further and explain. I hope this much you understood, and you are getting a clarity of what it is to the extent of these three words, right? Because we got to build up this concept on these three words. Let's see how we are going to build up and what exactly are this concept that is involved in this. Okay, for a minute before I go in, I find a few people have joined. Guys, please keep the context of discussion. I will answer all your queries, don't worry. But for some time we will talk about the concept of audit risk. Then I'll take all your queries. Shouldn't be a problem. Now going back, and I'm explaining these things very elaborately, wherein you can look at the first topic down there is inherent risk. What exactly do you think mean by inherent risk now? So if you're going to understand what inherent risk is, Erin, let's move on. Okay, IR. Let's go with the same thing. Inherent risk. This is a risk because audit is assuming the inherent risk. This is not arising at our level. We are not doing anything. This is the risk level that we are facing because management has not established any controls. Management has not established any controls. When management has not established any controls, which is the key factor here, so inherently there is some risk in the business. So what are we supposed to do now to reduce inherent risk, which is an inherent component? What are we supposed to do? Set up controls. Okay, this is the point. Now the moment you set up controls, what happens the moment you set up controls? There is a possibility that controls may not be able to prevent, detect and correct, prevent or detect and correct material misstatement. What you need to understand, see, a risk arises in the business, it's inherent, it's already there. That's called inherent risk. Why? Because there are no controls, such a risk is already there, it is existing. Now that that risk is there, it is brought down by what? Setup of controls. As you set up controls, the control may not be able to prevent or detect and correct material misstatement. You know what this is? The may not, the possibility of the control that you establish not doing this. This is called control risk. Control risk is a possibility that your control may not be able to detect and prevent a misstatement. Now that if that happens, that means controls are ineffective. Wherein you believe that controls are ineffective. Now please understand what is the relation between, now you will talk about the relation between IR and CR. What is the relation? See guys, a lot of people are kind of having this misconception. Okay, can I see a few answers on what is the relation between these two, right? Can I just, a lot of you are watching, right? Can you just tell me what is the understanding that you have about the relation between these two, IR and CR? What is the relation that they share? Can you say? Put up in the comments quickly. I would like to check that. Other concepts. Okay, there are so many people who have commented. Okay, here Narendra says thank you very much. You cleared very good, Narendra. Awesome way of teaching some need lectures and 500 series. We're trying to do that, but we'll see what some of the standards, the summaries are already there. You can obviously cross check them. I'm attending a virtual class, both are in good. And then no relation, inverse relation. They share inverse relation. Come on, guys. Somebody says there is no relation. Some people are saying inverse relation. Inverse relation. I see a lot of. Come on, the time for high is over. Yeah, high is done. Relation between IR and CR. Okay, very good. I see some answers. Nice ones from. Good. Go ahead. Come on, a few more. Taking a minute on that and then proceed further. Come on, guys. So now the point is inverse. I see a lot of inverse relationship answers. Are you sure that it's inverse relation? control risk comes into existence only because of inherent risk, but the vice versa is not possible. So yeah, what are you trying to say? I got your point. So what is it finally? One word for that. Inverse, inverse. Okay, hold on. So all of you guys who told that there is an inverse relationship, very good. You have successfully told a wrong answer. Let's learn how to correct it. Do not worry about it. The other guys who said there is a no relation, no direct, no indirect, no inverse, no direct relations. Okay, very good. Somebody put up exactly what the words are. Auditors should make combined assessment. Now, a lot of people who are telling inverse, they are of the simple opinion that when IR goes up, that is in IR there, the CR not there. Please understand, if IR exists, that means inherent risk is existing. There are no controls. When controls are not there, where is the scope of control risk? So when IR is existing, CR doesn't. Wherein the IR, I can't say IR doesn't exist, so it's brought down. That is when CR is there. So what are you trying to establish between something that is there and not there? So always remember the total risk that management takes up from this is what exactly is called the risk of material misstatement. The risk of material misstatement, wherein in all those areas where controls are lacking, you need to take IR. In all those areas where controls are established, but there is a possibility that the control may fail, there is CR. So always remember the answer to this particular point, keep it in clear idea. The combined assessment. So all those people who said inverse is where one comes down, the other one goes up. Here there is not one coming down, other one going up. If one is coming down, that is the other one is not existent. So if inherent risk is coming down drastically, control risk increases because of a simple reason that you set up controls. That time inherent risk is not there in all those areas. And same way, if inherent risk is prevalent, that is it is there. To say inherent risk is there, which the definition itself says, what is that? That controls are not there. That is why that inherent risk is there. So between something that is there and not there, how are you even establishing a relation? I appreciate all of you who have given answers, very good, but I believe now you got the clarity. So please understand that there is no direct or inverse relationship, because you can create a relationship only between two things that coexist, and these two things, they don't coexist in all areas where you have set up controls. In those areas the inherent risk is brought down by setting up of a control, so only control risk exists. So always there is a combined assessment. See guys, this is the kind of clarity that you need to have when you are targeting MCQs. Do not run behind materials answering 300 400 MCQs a day. That's not going to take you anywhere, as long as, because the last time we posted around 6 or 7 MCQs from this topic, majority of them got them wrong. Like they are inverse, direct. There's no inverse or direct. There is a combined assessment. Okay, did you understand the reason? I believe all of you got it. So if there is anything that you would like to ask about this particular thing that I just discussed, you might as well want to now post your comments. I will take a minute to read that and then proceed further, because this is your conclusion of part 1. This is what we call it as risk of material misstatement, which is one of the major components of audit risk. But none of these are something that arise at our level, because neither we set up controls nor we are leaving them. So the duty to set up controls is management, and if they don't do it, then inherent risk exists. If they do it, then control risk exists. So both these risks don't arise at our level. The sole and responsibility for all of this is with the management. But now that we perform compliance procedures to rely on some of these controls, we are taking them on our head. That is exactly why there is something called as IR and CR that is transferring on our head. Okay, so I believe all of you who have tried to tell direct or inverse relationship, you guys have an idea now, because direct relation means if one goes up, other one also should go up. Inverse relation is where one goes up, the other one comes down. But that's not the case that's happening here. Yeah, once again, guys, please concentrate. Yeah, I've seen a lot of people saying, explain the relationship again. Once again, this piece, I want you to concentrate. When do you think inherent risk exists? Inherent risk exists for a simple reason that controls are not there, right? So if inherent risk exists in some areas wherein obviously there is a possibility of something going wrong inherently, that means inherent risk exists. So in those area controls are not there. When controls are not there in that area where inherent risk is prevalent, now tell me, how are you trying to establish a relationship between something that is there, the IR, and something that is not there, CR? CR is not there, no. CR comes only when controls are there. And if controls are there, why will IR be there? So you are trying to create a relationship between there is one that is existent and other one that is non-existent. So it doesn't work like that. And in areas where you left out by not setting up any controls, you still have the IR prevalent in those areas, and all those areas management have set up controls, CR comes into picture. So totally, if you see in the entire organization as to what is the risk of something going wrong, in those areas where controls are not there, things can go wrong because of the inherent risk. In those areas where controls are wrong, things can go wrong because of control failing. So if you look at the overall perspective of how things can go wrong, that is what is the chance or a risk of material misstatement. In those areas, material misstatements can happen because of absence of control. The IR is responsible. And in those areas, despite control being there, still a misstatement can happen. That is the responsibility of CR. So totally from the management standpoint, if there is a risk of material misstatement that can occur, it is because of the combined assessment of both IR and CR. I hope I've been clear till here, right? So all those people who asked me to explain that again, I hope you've got it now. So that's your part 1 to the audit risk. So this piece what we've been talking here, risk of material misstatement, which is IR and CR. This piece I believe you can understand, because for a simple reason that, the idea is very simple, guys. What you're trying to do there is most likely something that you're trying to create a relationship between something that is existence and something that is not. So I don't think you should be, or you possibly will be able to do that. So in such a case, you might want to consider. Okay, everybody, are you clear? I hope so. So just in case you still have something to ask, do feel free to hit the comments. Do not worry about what others are going to think about reading your comments. This is between you and me, so straight you get this. I hope you got this frame clear, because this one is a very important frame that we talked about, wherein what is IR, CR, and all of that has been explained in this particular thing. So guys, that's what we have in this particular case. Let me move on. So as I said, going back to the previous case, herein we have detection risk coming up now. Let's move on. So after I explain all the 3 risks, then we'll frame the definition of audit risk. Clear? Perfect. Very good. Let's move on to this concept, wherein, let me get back to the same color that I used for detection risk. Okay, detection risk. What about detection risk? Now, simple logic, guys. Say if the quotient of inherent risk and control risk, let's say if the inherent risk and control risk, the combined assessment of IR and CR, this says it is low. Please understand. Now, when your preliminary understanding about internal control says that the possibility of something going wrong when it comes to a control is low, that means you believe what? You believe a fact that controls are effective. Don't you believe that? Controls are effective. This is when this case is low. Now when you believe that controls are effective, this leads to a situation where you will be doing more of substantive procedures or less of substantive procedures. Because IR and CR are low, which means the control risk is low, the combined assessment, controls are effective. Auditor tends to do what? Auditor does less of substantive procedures, because he has got high belief on controls. No, he's saying controls are effective. So he performs less of substantive procedures. Now, when an auditor performs less of substantive procedures, what does this lead to? When he does this, of course, what you have to consider is the quantum verified, let's say quantum of transactions or account balances verified. Now please understand the story here. Since the controls are effective, auditor tends to do less of substantive procedures, and when the auditor tends to do less of substantive procedures, the quantum of transactions or account balances verified by the auditor will be less in count, right? So less in count leads to a high detection risk. Now you're keeping this point as a high detection risk only because you trusted the controls. Okay, vice versa of all of this, I'm going to show you that as well, again based on the relation that we pick up, wherein if IR and CR, the assessment of that is high, when you say that means controls are ineffective, that is what the auditor concludes. Based on his preliminary understanding, he says controls are ineffective, the combined assessment of IR and CR is high. Then when this is high, when controls are ineffective, what does the auditor tend to do? The auditor tends to do more of substantive procedures. More of substantive procedures. When auditor does more of substantive procedures, it leads to what? The quantum of transactions verified will be more in count, right? When transactions verified are more in count, it leads to a low detection risk. I hope this piece is also clear to you. And this is the whole point of detection risk. Now, how does detection risk come into picture? Detection risk arises only for a simple reason that auditor's substantive procedures may not be able to detect a misstatement. Now this time the misstatement is not happening because of management negligence. That's over in IR and CR. So risk the transaction risk, that is something going wrong at the level of management, is nothing but a combined assessment of IR and CR. But now that you want to rely on those controls which have been set up by management to determine the nature, time and extent of substantive procedures, you're taking the combined assessment of IR and CR, and you have either of these two conclusions that you see on screen. Either you can conclude that IR and CR is low, which means controls are effective, or IR and CR is high, which means controls are ineffective, and determine as an auditor your substantive procedures you have to do less or more, wherein it leads to you quantum of verified being less, and it leads to a higher detection risk, wherein if you verify more in count, then it leads to a lower detection risk. So now if you see what is the concept, based on the IR and CR, if IR and CR are low, because of your procedures that you perform and the liberty that you take, you are ending up with a higher detection risk, because as an auditor you believe that doing less of substantive procedures also can give you sufficient appropriate audit evidence to reduce the audit risk to an acceptably low level. I will repeat what I said, but this is the activity. Once again, let me do that repetition with this, saying what? That when auditor believes the combined assessment of IR and CR, the controls are ineffective, he can't trust the controls because the IR and CR combined assessment is high. So since already there is a high risk over there in controls, he is expecting a possibility that misstatements can occur more in number, and there is a possibility that it have occurred. And because misstatements have occurred more in number, the auditor tends to do more of substantive procedures. And when you are doing more of substantive procedures, the quantum of transactions and account balance that you verify in terms of count, they are very high. So the possibility of your substantive procedures going wrong will be less, leading to a lower detection risk, which in overall means if you have a lower IR and CR, you have a higher detection risk, and vice versa. Now for the conclusion of the concept of audit risk as in whole, what is the concept of audit risk if you have to pull out? Now that you know all those three words, I'm just coming back to the basic concept of what audit risk is, right? So since it's risk, let's go with red. So what is it? Risk that auditor expresses, risk that an auditor expresses an inappropriate opinion an inappropriate opinion. Now that is the most important part of the story. The chance of you giving a wrong opinion, inappropriate opinion. Why do you do that? Risk that the auditor express an inappropriate opinion. That too when financial statements are materially misstated. Now this was a question in the past I put up on the MCQ also. A lot of people who, I mean, if there is anybody who's watching this for the first time, our MCQs are being put on our Instagram handle, so just check that out. I just wanted to let you know that. A risk that the auditor expresses an inappropriate opinion when financial statements are materially misstated. So something that is wrongly stated because of the auditor giving, I mean, like something that's going wrong. There is a possibility of you giving a wrong opinion. See guys, when financial statements are materially misstated, what is the opinion that you can give? Okay, you give whatever opinion, but you definitely will not be able to give something that is true and fair. So true and fair is not an appropriate opinion in that place. But the possibility where even when the financial statements are misstated, you end up giving true and fair. You end up giving true and fair when they're actually not true and fair. You're not supposed to give true and fair, but you gave true and fair. This possibility is called as audit risk. Remember that. Okay, just in case you forget any time as to what that is. See, what is the main idea of audit? The main idea of audit is to express an opinion, right? The possibility of you doing that wrongly, that's all. That is a risk in audit. The maximum what we expect from an auditor is to give an opinion. And when he is giving an opinion, if he is giving an opinion which is not something that he is supposed to give, that is when financial statements are materially misstated, he should end up giving an opinion, but he didn't, and that could lead to a particular problem in this case. So got it? That's the whole concept of audit risk. Now if you link up this concept of audit risk, finally you talk about the relationship. Whatever concepts you learned, what is the relationship between them? See, you cannot do anything with respect to IR and CR separately, because IR and CR together, there is a combined assessment. And because there is a combined assessment in IR and CR, as I showed you in the previous thing here, based on the total detection risk that's going on, what you can see right now on your screen, that is exactly what is happening. Because of a low detection risk, it's leading to, I mean, because of a low IR and CR, it's leading to a high detection risk, and vice versa. When there's a high IR and CR, that means when you can't trust controls, you end up performing more substantive procedures, which would lead to you finding a lower detection risk, which means when the combined assessment of IR and CR are high, the detection risk that you're talking about will be lower. DR will be lower. And when IR and CR are lower, which obviously means that you can skip a lot of transactions because your controls are very strong, DR is high. Therefore, what I want to conclude is that between the combined level of IR and CR and the detection risk that the auditor frames, there is an inverse relationship, or rather the auditor should keep an inverse relationship between IR and CR versus DR. Okay, so that I believe has given you some kind of a clarity on what this topic is all about. Okay, so let me take a minute to see your points and questions. So if there is anything that you would want to convey at this point of time, you can as well do that, because let me take your questions for a couple of minutes and then I will go on to the next topic that we're discussing there, that is sampling risk. So IR, CR and DR, are you clear about these three concepts? And put across to the total concept is called audit risk, wherein the probability or the chance that the auditor may end up giving an inappropriate opinion, where he should not give a true and fair view, he ends up giving a true and fair view. That's a huge risk that purely is dependent on the relationship that you see on the screen, where there's a inverse relationship between IR and CR with the DR. Now, I want to also classify one more very important point here. In all of this concept that we have seen till now, there hasn't been no discussion on sampling, right? So all that I want to convey is whether or not you do sampling, audit risk continues to be there, as you see here. But wherein when you talk about doing sampling, additionally the risk because of your sample not helping you to detect a misstatement, where then there is a sampling risk that can additionally crop up. You understand what I'm saying? That can additionally crop up. So all you need to understand in this particular case, you have to see what exactly are you dealing with, which sort of a risk, what it is, and all of it. Okay, so let me take your questions, and in case there is anything, okay, I'm seeing some thumbs ups. Fine, very good. If you have understood it, very nice. And if at all there is anything that you want to ask for, you can quickly do so, because I will be moving on to the next concept here, wherein what we are calling it as sampling risk. So I'm not going to deal all the individual concepts of sampling. I'm just going to talk about sampling risk, because again, when we put up MCQs, a lot of people wrote that sampling risk is part of audit risk, which is absolutely not. Sampling risk arises because of sampling. Remember that sampling risk arises only because of sampling. But whether or not you do audit procedures, whether or not you do sampling procedures, still audit risk continues to exist. Okay, so what questions are coming in here? When there's a high risk direct relationship with substantive procedure, when there's a high risk, I didn't get your point, Rubashri. What is it that you're trying to ask? When there's a high risk, yeah, obviously when there's a high risk, what do you mean by when there's a high risk of IR and CR? That means you believe controls are not operating effectively. You should perform more of substantive procedures. See, one thing again I want to clarify to all you guys. Please understand, this is not a case where because this is high, this is low. Because IR and CR are high, you have to keep the detection risk low. You have to. So it is in your hands. When you believe that controls are not operating effectively, it is your duty to make sure that you do more of substantive process and bring down the detection risk. So I hope that clarifies your point. And when IR and CR are low, which means the controls are absolutely effective, you might tend to take a chance on not doing so much of substantive procedures, wherein the risk of you not doing that many substantive procedures is very high. So understood? That particular thing you should be very clear about. Just in case you want to ask something else, you can put it up. In case, sir, can you upload PDF material on standards? Standards, my standards or anybody's standards are all the institute material content only. I mean, just in case you want something, leave a text directly. I'll try and do that. In case financial statement not materially misstated, but auditor gives an otherwise opinion. Yes, very good. That's a very important point. And Ganesh rightly put it up there. Venkat, it's not part of the audit risk. Exactly. See, when financial statements are not materially misstated and you end up calling them misstated, that I don't believe that is any kind of a risk. See, because that's not part of audit risk. That is a negligible part. Because by the time you gather audit evidences and you come to a conclusion, I believe you should be able to establish the fact. When financial statements are not misstated, why would you go and call it misstated? And why would the management let you give a report like that? So again, when financial statements are misstated, if you are calling them true and fair, that is a big risk. When financial statements are really true and fair and you are calling it not true and fair, I don't think that's part of an audit risk, because an auditor generally is not in a position to generally do that, because even the management at their standpoint will be very clear. Because how can you tell a financial statement is absolutely true and fair? For what reason will you call it? So again, that is not part of the audit risk that is given. Okay, Rubashri got it? Fine, that's the point. If there is anything else on this topic, take a minute to hit your comments, and then we will continue with what is called as the sampling risk that I'm going to take up the next topic. Okay, so I believe everybody has understood. If just in case you need something else, we will talk about it. Moving further, we talk about sampling risk. Sampling risk is that a concept wherein sampling risk arises only because of sampling. You know what a sample is, and you know what sampling risk is. Auditor's conclusions. So auditor is deriving some conclusions, which obviously as an auditor you're supposed to do. Where an auditor's conclusions, two things can happen. Auditor's conclusion based on sample that is picking up, versus auditor's conclusion based on the population. See, ideally, if the auditor selected a right sample and if he's trying to do the sampling technique properly, the auditor's conclusion based on sample should be almost the same with auditor's conclusion based on population. Okay. But just in case where there is a possibility that the auditor's conclusion based on sample may be different from the auditor's conclusion based on population, such a chance or such a risk is called as audit risk. Okay, sorry, that's a sampling risk, because based on sample you might end up giving an inappropriate opinion. When you actually done the entire population, you would have come to a different conclusion, and that possibility is called sampling. Now this possibility is there only because of you doing sampling. Now if you don't do sampling, this particular possibility will not be there, but still audit risk will be there. Understood? So there is no real reason why you have to comment on audit risk when you talk about sampling risk. So sampling risk is not part of audit risk, and if any of you are still trying to understand why, please go back 5 minutes to the video and try and understand what I just said. Okay, sampling risk arises because of sampling, but audit risk is obviously there because the auditor is expressing an opinion and there is all possibility that he can anytime go wrong with respect to that. So moving further, guys, what we are talking about is the sampling risk components. Why does sampling risk arise? What are the possibilities of sampling risk? Now, if you look at what actual possibilities are, so I want to explain you this table. There are two types of procedures. Okay, there are two types of procedures. What are those? Compliance and substantive. Compliance and substantive. Now when you know that these two are the procedures that you follow, all that I want you to understand is what conclusions did you derive based on sample versus population. Now what is the possibility something can go wrong? That is only called the risk, which leads to what is the effect. So these are the points that I want to right now consider. So as I consider, okay, let me see, I'm not putting up anything on this. Okay, so I believe and fit myself in that. If not, just hold on, I will move myself a bit. Okay, so I think that fits in. Got it? Okay, let's go now. Right, so as a matter of fact, if you look at it, if this particular table is a very important one. Now if you look at it, for compliance procedures based on, so compliance procedures is what? Test of controls, right? So based on compliance procedures, that is test of controls, and then we will do the same thing for substantive procedures, which is test of transactions and account balances. Now these two are happening here. Okay, whatever we are talking about should now look at what we do in compliance procedures. Now watch out, guys. Compliance procedures, based on the sample that you picked up, you decided that controls are effective. Based on the sample that you picked up, you decided that controls are effective. But if you take up the entire population, they actually are not effective. Okay, but now if you understand the logic here, when you based on the sample concluded that they are absolutely effective, that means you will compulsorily going to rely on those controls saying that yes, they are effective, and you will do less of substantive procedures. And since you're doing less of substantive procedures, there's more of detection risk. So you end up unnecessarily relying too much on controls. Based on the sample, you relied too much on that, where that much reliance was not required, and that risk is called risk of over-reliance. You unnecessarily relied on controls, and now that you have strong belief that controls are operating very effectively, you will end up giving an erroneous audit opinion. That's a big challenge. It's an erroneous audit opinion. Moving further, the opposite of this case, what's happening there? In that particular case, based on the sample, auditors concluded that controls are not effective. Now if you watch this close very carefully, if this is not effective, based on population, it is actually effective. Now see what the seriousness of this particular thing is. When you say controls are not effective, Will you tend to check more controls? Definitely. Based on sample, when you come to a conclusion that it's not effective, I want to increase my sample size. That is the idea of sampling. No, when your sample indicates that there could be a possible misstatement, you will go with more sample. So when your sample says controls are not effective, then you will extend the sample size. When you extend the sample size that you're almost increasing the population, eventually you will get to know the reality that yeah, okay, they are actually effective. But had you relied on the sample and concluded that yes, this is a good sample, I can rely on these controls, which you didn't do. So in this particular case, you didn't rely where you could have relied. This is called as risk of under reliance. But this time, you didn't end up giving a wrong opinion. But all that you did is you extended your sample size again and again, wherein you ended up doing more audit work. You ended up doing only more audit work. You understand? Now, coming on to the substantive procedure story. This time it's a transaction account balance. No. Based on the sample, auditor concluded that material misstatement does not exist. Auditor concluded that material misstatement does not exist. Now the moment of fact that where he concluded that material misstatement does not exist, but actually if you check the whole population, material misstatements exist as per population. So you took a sample, you checked that sample and you believe that there are no misstatements, and you concluded saying that there are no misstatements in the entire set of financial statements. That is absolutely wrong, because actually they exist. Had you extended your sample size, you would have found it. But that is a risk. No. You picked up a sample which is indicative that misstatement do not exist. You incorrectly accepted a sample and you said that yes, this is the sample, and according to this you say misstatements don't exist. Your mind doesn't let you go any further, and then you stop and say yes, misstatements don't exist, where in fact actually they exist. Had you extended your sample size, you would have really found them, but you didn't, because you incorrectly accepted a sample. This is called risk of incorrect acceptance, which is also a part of sampling risk, which will again lead to erroneous audit opinion. You are giving wrong audit opinion. There are actually misstatements in the financial statements wherein, but now your sample said misstatement does not exist. So you will end up giving a true and fair view, saying that yes, based on the sample verification that I did, I conclude that the financial statements are true and fair. But you incorrectly accepted a sample and you are giving the opinion, which is an erroneous audit opinion. And lastly, if you are looking at a case wherein of the opposite, actually by sample you decided that material misstatement exists. Now the moment an auditor concludes that material misstatement exists, what will he do? He will tend to increase the sample, right? So you check 60%, or you will go to 70%, then 80%. And actually in the population, material misstatement does not exist. And when actually material misstatement does not exist, you unnecessarily rejected a sample. Based on the sample, you could have definitely concluded that yes, material misstatement does not exist. But you didn't do that based on the sample. You took more sample, you only ended up doing more audit work because you incorrectly rejected a sample, and this is called risk of incorrect rejection. And since that is called risk of incorrect rejection, you will only end up doing more audit work, which is again just like very similar to the case. So in these two cases wherein you see risk of under reliance and risk of incorrect rejection, we are only doing more audit work, but we are not giving an erroneous audit opinion. But if you see that this risk wherein over reliance, right, and of course incorrect acceptance, both these we are looking at something very dangerous, because in case of over reliance or incorrect acceptance, in both these cases you ended up giving a wrong audit opinion. Now this is the breakup of what do you call as a sampling risk. Understood? So these are the two procedures what you apply sampling for, and the total of all this four, the total component that your sampling procedures may not be able to identify a misstatement, that is exactly what is called as a sampling risk. So I want you guys to understand this particular topic very carefully, because again there is a lack of clarity with respect to this. Okay, so I hope you guys are understanding this, and just in case, so that is what the idea is, and that is what the concept of sampling risk is. Now, some of them have asked me to describe what an anomaly is. So, as a matter of fact, anomaly is a transaction, like it's a misstatement or a deviation which is not a representative. It is not a representative of the population. Okay, for a simple reason that, like, say it is one of its kind, it's some kind of an item which is one of its kind. Uh, so therefore, you need to understand that anomaly is a misstatement or deviation which is clearly not a representative of the population. So anything that you conclude keeping anomaly in mind for your population, that is going to go wrong, because that is not a true representative of the population. And since it is not a true representative of the population, any conclusion that you make keeping an anomaly in mind. Now, how do I determine that is an anomaly? That will be based on your professional judgment in that case, and you will decide that's an anomaly. But if at all you decide a transaction is anomaly, that is, see, this is one of the kind in the sample. See, generally when we find a misstatement in a sample, what do? We extend the sample size. When you extend also, you're not finding it. This is one of its kind. So when it is one of its kind like that, you might call it an anomaly. And if you read the standard carefully, essay 530 on sampling, that says anomaly can happen in extremely rare circumstances. So in extremely rare circumstances, when you consider a particular item, to be an anomaly, you need to decide that you are not going to take or make conclusion based on what anomaly is. So there can probably something go wrong. That is what anomaly is all about. So can you please give meaning of erroneous? Erroneous means something wrong, inappropriate audit opinion. Please also consider more cases, like in case of tolerable rate, in case of tolerable test of control is tolerable error and tolerable deviation. What is that you want exactly? Venkat says, got it, very good. Please explain factors influencing sample size for test of control and in case of test of detail. Boss, you're asking me to explain the whole standard. See, okay, I can do that. But the fact of the matter is that, like sample size, design, I believe if you can read those things and understand, it will be better. Because I explain things in the air, then again, you will definitely not be able to catch up which point is what. So yeah, please read 530. Do not hesitate to shoot up, because the thing is, if I'm explaining those factors, I might want to list down those. And again, without those proper factors, you can't catch up. Now, like say I can give you tolerable error and tolerable rate of deviation, the maximum that the auditor can take. And what is tolerable will be something that is determined in the circumstances of the audit based on the auditor's professional judgment. So if your tolerable rate of deviation is very high, okay, tolerable rate of deviation for control is very high, that means you believe that even if the control is ineffective, that is deviating so much, but still you're okay with it, then obviously that will end up to a higher risk, because you're relying on those controls which are not actually that great. Same thing happens with tolerable misstatement. If you set up a high tolerable misstatement, you're tolerating such an amount which is very high, I don't think you will be able to, every misstatement then will look small. So based on that, you cannot make conclusions. So that's what it is. So all you guys who are saying got it, very good. I thought the basic idea, because I've been putting up MCQs and a lot of people are making mistakes in this topic of audit risk and also sampling risk. So I thought and then so many people have texted saying that the concept of audit risk of IRC are not clear. So what I would like to tell you at this point of time is, these are the two concepts that have been scheduled for today. What you guys can do is to redo this video just in case if you want a thorough revision on this. You might as well want to try and redo this video so that you can have a complete idea as to what this is. And once again, people have come up and they're telling that they got marks in the past, in the last attempt. All that really motivates us to do more. And for those guys who've joined newly on the platform today, if most of you are continuing, please do let your friends also know that we exist on YouTube and Instagram and Facebook on the above links. And of course, that we guys are absolutely not commercial on any of these platforms. So for a simple reason, I want students who are lacking clarity with the subject to be having clarity. That's the motto of putting it up. And then we put up a lot of questions on Instagram of MCQs and also Facebook simultaneously. And all our live sessions are through this channel, so which you already know. I will see you with another very important topic. And just in case if your friends haven't done their classes or they have not done, or if you are looking for any of the classes, there is also our website tuition.in where you can get all our classes or all my classes on IT, EIS, SM, audit, all online available. So if you want to, if you haven't finished your coaching or if you're still trying to get clarity about the subject, you might want to go there and visit and do the obviously needful. Otherwise, I will see you very soon coming back on another live session wherein we'll come back and catch up with another topic. Probably this time we got to get some more things. One more small suggestion that I want to give at this point of time is please do not run behind the MCQ materials and PDFs and all that. Right, you can solve them later in April coolly, because right now is a time for you to study, understand, and do well with the concepts. Please do that, because again, I'm not saying I'm fed up of seeing that, but every day somebody or the other keeps asking me for those PDFs and answers. That is not how you prepare for an MCQ exam. You got to be very thorough with the concept. Practicing 500 MCQs, there is no surety that all your 30 questions are going to come from that. Okay, practicing all the concepts while having thorough understanding. If not 30, you can write 300 MCQs. So please understand the logic of why I am saying that, and try. I mean, of course, it's for your benefit that I say that, because end of the day, if you get great marks, I'm only feeling happy. Beyond that, there's no real uh, gain on what's saying that. Okay, so all those. Sir, very good style of teaching, superb. Yeah, thank you, Rahman, you put that up. So all those people saying thanks again, like I always say in every session, I believe it's something that I can do online. So I really feel, since I can help you guys if you're in need, that I don't feel it really a pain to do that. So thank you all guys for staying with the live session. I will see you soon with some other topics, and a lot of things are lined up for you guys. There are some revision sessions, there are some doubt clarification sessions, there are some MCQ sessions, so all of which are coming. So do stay subscribed to the channel, and we'll have the updates. Yeah, Facebook link, Insta link, YouTube link, everything is on your screen. Just check that with those names, guys. And of course, do let your friends do know that. Okay, thank you guys. So it's really nice to have you on the live session. I will see you in the next live session, guys. Good night.